Hello and welcome to the video on horizontal and vertical analysis. Horizontal analysis is a very simple tool to analyze financial statements. Essentially, all you're doing with horizontal analysis is you're comparing the current year's performance to the prior year's performance. And we can look at financial statement numbers such as the balance sheet, income statement or cash flow statement and compare this period's numbers to prior period's numbers. Essentially, that's horizontal analysis. More formally, we'll say that we're going to calculate the change in an account balance from one period to the next, and we're going to express those changes in both the dollar amount and the percentage changes. The purpose of horizontal analysis is to reveal any large fluctuations or variations in the business. It can then identify items for further investigation. If we see our business has large spikes in the inventory, we then go and investigate, why did our inventory go up? Is it because we built a new store and inventory went up because we are storing in a new warehouse for this new store? Or is it because we weren't selling our inventory because our products have become unpopular? Here's a little example of horizontal analysis on the balance sheet. I'm using numbers from the Gale Pacific 2017 and 28 financial statements. And on the balance sheet, we can conduct horizontal analysis on all the accounts there. I've just started with current assets such as cash and trade receivables. We've got the 2017 balance and the 2018 balance for these two accounts. Horizontal analysis can be conducted using the absolute value of the dollar change and as a percentage change. And I've got the two calculations for us here below. In 2018, the change in cash decreased by about $1.983 million for Gale Pacific, which was a 7.9% change in their cash balance. Okay, so the calculations are relatively easy. What does this mean? Well, for nearly every calculation we do here, an increase or a decrease could be good or bad depending on the circumstances. So what the analyst needs to then do is go in and try and find out, why did the cash balance go up or down? Cash decreasing could be a good thing if we spent the cash on good investments. Cash going down might also be a really bad thing if our business is losing money. We'd check our cash flow statement. If we're generating negative cash flows from operations and that's what caused the cash to decrease, that could be a problem. However, if our cash flow was negative because of strong investments, maybe that's a good thing because it will pay off with more cash down the line. A similar story for trade receivables. An increase in trade receivables might be a good thing. It might indicate that we've sold more during the year. Our sales went up, so of course our trade receivables went up. Or it could be a bad thing. Some of our customers haven't been paying us back, or we've loosened our credit on sales, so therefore our accounts receivable is increasing at a rapid rate. So for all these changes, horizontal analysis just identifies areas of change in the business, and it's then up to the analyst to go and try and identify what caused those changes, what actually happened in the business that led to these changes. We can also do the same sort of horizontal analysis on the income statement. Here I've provided numbers for the sales revenue and other income, and we've seen that the sales revenue for Gale Pacific decreased by about $26 million for the year, which represented a 15.1% decrease in their sales revenue. Now again, in most cases, a decrease in sales revenue is probably not a good thing. However, if a business has closed down some stores or closed down parts of the business that were underperforming and not generating a good return, then this might be expected and it might be an okay result. However, most of the time, a decrease in revenue is not a great thing, but we still need to go and investigate what caused this decrease in revenue for Gale Pacific. So all horizontal analysis does is it identifies areas of change in the business. It's then up to you to try and find out, was that change a good one or a bad one? And most importantly, what actually caused it in the real world? What was causing these numbers to fluctuate? Vertical analysis is a type of analysis where we'll look at the financial statements and compare individual accounts divided by some sort of base account. So it allows us to compare different companies or even the same company through time and see how the business is changing. For the balance sheet, you'll divide every account by the total assets. The reason for that is the total assets is going to be the largest number on the balance sheet. So we want to see how each of the different accounts makes up the total asset balance. What percentage is cash of total assets, for example. For the income statement, we're going to divide everything by sales revenue. For a profitable business, the sales revenue number is going to be the largest number on the income statement. So we can then go and divide all the different expenses by our sales revenue to see where we're actually spending our money in the organization. So a vertical analysis of the balance sheet for Gale Pacific in 2018. I've chosen again cash and trade receivables from the balance sheet. And we can see that of the total assets in Gale Pacific, 15.8% is made up of cash. Now that is quite a high amount. Maybe they don't have any good investments that they can think of to spend their cash on, or maybe they've got a big debt repayment due soon, so they need to have the cash on hand to make the payment. So although this is a reasonably high percentage of assets in cash, it might be a good thing, it's safe, or it might be a bad thing. We've run out of investment opportunities and we can't think of anywhere better to park our money. A similar story for trade receivables. 23.8% of total assets are trade receivables. If this number is getting higher and higher over time, that might represent that our customers aren't paying us back quickly, or we've got looser credit policies. So it might be a bad thing if it's a high number and increasing, or it might be a good number in that it means we're generating a lot of sales and we've got a good turnover there. We can also do vertical analysis of the income statement as well. So here we divide through by sales revenue. So my sales revenue of 2018 is my denominator, and I can find out that raw materials represent 65.2% of my total sales. So for Gale Pacific, who are a manufacturing firm, their largest expense is buying raw materials to make their products. And that makes sense. Another big expense for them is their employee benefits, their wages. So as a manufacturing firm, their materials cost a lot, and they have to pay a lot to their staff to actually make their product. Then as you go down the different expenses, things like depreciation make up a much smaller portion of the overall revenue that Gale Pacific earn. Horizontal and vertical analysis is not complicated. However, it's very commonly done. The reason it's commonly done is because it's not complicated. It means that everyone can understand the analysis, and it's used a lot in annual reports and discussions by the board of directors. It allows us to focus on areas of the business that have changed, which is often a sign that something needs to be investigated in more detail. So although horizontal and vertical analysis is simple, it can be a very powerful tool in understanding the changes in a business. Thank you.